Welcome to Business News SA. Today we take a look at business funding and finance for your startup. Money makes the world go around, and this is particularly true for startups and businesses. Without capital to get off the ground, you'll never grow. To get you started, we have compiled a definitive guide to securing business finance and funding in South Africa. There are two ways to launch a business: with funding, and without it. 99% of businesses in South Africa fall into the second category. They launch a business without any financial assistance. They then fund each month's operations through sales, either of products or services. This is known as bootstrapping, and you can learn more about how to bootstrap your own business in our article, Launch Your Business Without Funding. Some startups can't be launched without business funding though, and most companies reach a point where they need some capital to help them grow or fulfill a large order. This is where business funders come in. From banks to venture capitalist firms and even the government, there are substantial sources of financial aid available for you to boost your business venture. You just need to know what type of business funding suits your business best. In this video we unpack the difference between government grants, loans, equity funding, venture capital, angel investment and personal debt finance so that you can determine which funding or finance options best suit your needs. What's in this video is government grants, loan financing, equity funding, venture capital funding, angel investment funding, personal debt finance. Articles Understanding Business Funding and Finance for Your Startup. There are two ways to launch a business: with funding, and without it. 99% of businesses in South Africa fall into the second category. They launch a business without any financial assistance. They then fund each month's operations through sales, either of products or services. This is known as bootstrapping, and you can learn more about how to bootstrap your own business in our article, Launch Your Business Without Funding. Some startups can't be launched without business funding though, and most companies reach a point where they need some capital to help them grow or fulfill a large order. This is where business funders come in. From banks to venture capitalist firms and even the government, there are substantial sources of financial aid available for you to boost your business venture. You just need to know what type of business funding suits your business best. Business funding in South Africa. In this guide we unpack the difference between government grants, loans, equity funding, venture capital, angel investment and personal debt finance so that you can determine which funding or finance options best suit your needs. What's in this guide? Government grants, loan financing, equity funding, venture capital funding, angel investment funding, personal debt finance. 1. Government grant funding. What are government grants? Government grants for small businesses are popular with startup business owners because unlike bank loans that need to be repaid with interest, grant funding does not need to be repaid. This doesn't mean it's free money. The hurdles you need to go through to access partial or full financial support can be intense. To access grant money, you'll need to submit all the right paperwork, 100% correctly. Your business will need to align with a specific project or initiative. This is listed on the agency or department's website. Make sure you approach the best government agency for your business. They don't work together or refer applications to each other. Because grants do not need to be repaid, there are strict guidelines for applications and the process is lengthy, so expect this to take a long time. Once you're successful though, you will have the funds you need to launch and grow your South African startup and change lives. Business funding in South Africa that is backed by government generally supports Black economic empowerment, job creation and developing the economy. Most government grants are exclusively for previously disadvantaged individuals. This group includes Black-owned, youth-owned and female-owned businesses. You don't need to pay grant money back, not even interest, but there may be certain conditions attached to the funding. For example, you may be required to hire local staff, as one of government's goals is job creation. Grants are designed to help you build your business, but also to pay it forward, so consider who else will benefit from your small business's success. South African government grant funders. The South African government's grant funding options favor business ventures that aim to make a difference to the local economy. These business startup funding institutions include National Youth Development Agency, NYDA. The NYDA provides business funding for startups and established businesses run by young entrepreneurs between the ages of 18 and 35 years. Funding ranges from between R1,000 to a maximum of R200,000. Before you can access funding, it's mandatory to get involved in the NYDA Mentorship and Voucher Program for a minimum of 2 years. Youth Pipeline Development Program. This program is run by the IDC and is designed to help aspiring applicants understand the funding process and fine-tune their request for funding proposals. This increases their probability of being considered for IDC business funding as the business and entrepreneur matures. Isa Van Women's Fund. Available only to women, the intention of this fund is to empower female-owned business ventures. In addition to funding, education and training is also offered. Black Industrialist Scheme, BIS. The BIS offers business funding on a cost-sharing basis. In other words, this grant awards funding to a maximum of $50 million, depending on how much of the business is Black-owned or managed. It supports businesses that will make a greater impact on society, job creation and empowerment. Tourism Transformation Fund. Supports companies that provide services directly to tourists and are 51% Black-owned. The grant funding portion is capped at $5 million. Technology Innovation Agency, TIA. The TIA has a number of grants available to fund startups based on research conducted in partnership with a higher education institution or science council. The funding amounts average are $200,000, but up to $1 million can be awarded. Small Enterprise Finance Agency, SEFA. SEFA is affiliated to the IDC and government and has access to $1.4 billion, which it is mandated to invest in South African small businesses over the next few years. Improve your chances of accessing grant funding. Middle. Research each grant fund thoroughly before approaching them. Middle. Find out what they stand for, what they are trying to achieve, and who they have awarded grants to in the past. This should all be on their websites. Middle. This is a long process with a huge amount of paperwork, so you don't want to waste your time on funds that don't invest in businesses like yours. Middle. If there is an export council in your industry, approach them as well, they will be able to assist you in the entire process. What are loans? A loan is a line of credit offered in exchange for interest payments on top of the loan repayments. The lender does not take any form of ownership, known as equity, in the business, although some surety is generally required in order for the loan to be approved. Banks versus alternative funders. Banks are risk-averse. This means that Middle. They invest in businesses, but they need to make sure it's a safe investment. Middle. Their return or what they make from the investment is in the form of interest repayments. Middle. A strong track record and usually some form of surety are required to access a business loan. More recently, alternative funders have joined the lending space. Some of these funders are niche players who focus on specific industries that they are very familiar with. Others have repayment methods that do not require surety, something many startups and smaller businesses do not have to offer in exchange for a loan. Many startups are too new to have a strong track record. Others have nothing to offer as surety for the loan. As a result, many startup founders apply for a personal loan based on equity and personal surety instead of a business loan. Should you choose to fund your business using money from a personal loan, the lender will only consider your personal finances, and a credit score over 700 is required to qualify. If you have great credit, you're one step closer to being approved for a business loan. Lenders usually look at your credit history and your personal finances before supplying you with business funding to launch your startup. They want to make sure you're good with money. A small business loan is also a good way to ensure you have a cash cushion if bootstrapping isn't an option. If you're borrowing from a bank, you will probably set up a payment plan outlining the term over which you will pay back the loan, usually in installments. Generally, a business loan must be repaid with interest. What is equity funding? Unlike a business loan, the investor takes an ownership percentage of the business in exchange for funding. There are no monthly repayments or interest repayments. Equity funders include Middle. Venture capitalists, VCs. Middle. Private equity firms, PE firms. Middle. Holding companies that own a number of businesses. Who is equity funding best suited to? It's easier for established businesses to secure private equity, PE, funding for expansion than it is for startups who are launching a business. This is because private equity funders are interested in growing their investments, which means they want to see a track record before investing in a company. How is equity funding repaid? Equity funding is not repaid like a bank loan. Instead, investors make money in two ways. Middle. They earn dividends when the business makes money. Your equity finance agreement will outline the percentage of profits your investors will earn and when they will earn it. Middle. They make money on the sale of their shares. All investors will eventually exit the business. When they sell to another investor or holding company, the goal is to make more from their shares than they initially paid for them. What is venture capital? A venture capitalist is an equity investor and their main focus is making money from their investment in your business. This means that they are likely to invest exclusively in businesses that can provide good returns on their investment. Who is best suited to venture capital? Businesses that are specifically built for growth are most suited to venture capital. A VC will typically want to exit or sell their shares within 5 to 7 years. At that stage, they will ideally sell their shares for 10 times what they paid for them. A venture capitalist is therefore looking for 3 things. Can the business be scaled at a low cost, without increasing overheads as you add customers? Read our growth guide, 6 growth accelerators to transform your small business into a big business to supercharge your growth. Do you have a specific growth plan that includes how you will increase their investment tenfold? Do you have the team, product, market experience and customers to accelerate your growth? Make sure you can answer these 3 key questions for funders. Will they make money on the deal? Do you and your team have the experience in your market to drive growth? Have you considered where the business is at risk and planned for this to protect your funder's investment? What is angel investment? Angel investors aren't financially motivated. They are usually friends, family, mentors or people from your network who believe in your business or in you personally and want to assist you. Many are business owners themselves who are paying it forward by assisting young entrepreneurs get started. Who is angel investment best suited to? Angel investors usually go the extra mile when offering business funding to small businesses. If you need assistance bringing your products to market, recruiting the right people or access to a larger network, the right angel investor can be a great partner. How is angel investment repaid? Angel investment is a type of equity funding. In exchange for the capital you get to kickstart your business, the investor gets an ownership stake in your company. The success of your startup means you'll both benefit from the investment. If your venture doesn't succeed though, you won't necessarily need to repay the funding, unless previously arranged. What is personal debt finance? Personal debt finance is when you use personal means, including credit cards, home loans or even your pension fund, to fund your business. Who is personal debt finance best suited to? Most businesses are self-funded. This means you've either been able to save a substantial amount of money, or you can access funds through personal debt. This method of business finance doesn't require you to convince others to back you and you're able to maintain full control of your business. How is the funding repaid? Whether you've used your personal credit card, accessed funds in your home loan or drawn from your pension fund, the money needs to be paid back. Thanks for watching, that is all for today.